Good morning and welcome to Charting the Markets on Thursday, the 31st of August 2023. Earlier this morning, we had Chinese manufacturing PMI data out, which came in better than expected, but it was still below the 50 mark, meaning that it is still in contraction. And added to that, the services PMI came in also weaker than expected and dropped to an 8-month low. And the impact of this on equity markets was that Asian equity markets were a bit mixed, Hong Kong and Shanghai indices falling, whereas other Asian equity markets still remained in the green. But we also had data out from Japan. We had industrial output, which dropped by a more than expected 2% year-on-year versus a forecast minus 1.4% fall. And we also had the Bank of Japan basically saying that it remains fixated on trying to generate growth in the economy and that it will most likely not intervene before the Japanese yen weakens to around 151 against the US dollar. Now, after yesterday's Spanish and German inflation rate, which came in slightly higher than expected, you might remember that German and CPI inflation came in at 6.1% versus an expected 6.0%. We earlier this morning had Eurozone inflation out, and again, it came in slightly higher than expected at 5.3% for both core and headline inflation. Now, core inflation did fall from 5.5% in July to 5.3% now in August, which is a good sign. But the headline inflation rate remained at 5.3% instead of dropping to an expected 5.1%. So with inflation remaining quite sticky in Europe, the question is, will the European Central Bank hike its rates in its September meeting in the middle of the month, or will it not do so? And interesting enough, at the moment, about half of investors think that it might actually not hike its rates after the unemployment data and the inflation data we've seen over the last few days in the Eurozone. But now with these readings from yesterday and today, it is possible that the European Central Bank might still have to hike rates in September. So we'll have to follow that one closely. Let's have a look at the economic calendar. And on the inflation side, we've got the US Fed's preferred inflation reading, that is to say the US PCE price index for July, which comes out at 1:30 p.m. and which is expected to rise to 3.2% year on year and to remain unchanged at 0.2% month on month. We also have initial jobless claims out, and then at 2:45 p.m. US Chicago PMI data for August, and that we expect to rise to 45 month on month versus 42.8 in the previous month. And let's have a look at what this data can do to equity markets, because equity markets, and we can see here on the FTSE 100 index, have regained some of their losses that they had during the month of August. And with regards to the FTSE 100, we bounced off some pretty good support and have now risen to the orange line here, the 55-day simple moving average at 7,485, where we are struggling slightly ahead of tomorrow's non-farm payrolls data in the US. Now, from a technical perspective, what has happened, though, is that we have broken through the July to August downtrend and have managed to close above it and hold above it, all of which is actually positive for the bulls. So even if we were to see a minor retracement lower over the next few days, and perhaps at the beginning of September, because after all, September, around 2/3 of cases since the Second World War, is a month where European equity markets at least seem to have not that positive a month, and could sometimes also end up in negative territory. So it is not a month which usually is associated with great gains. But nonetheless, from a technical perspective, provided we stay above this key support area with regards to the FTSE 100 between 7,228 and 0.4, that is to say the March and July and August lows, then further upside might actually be in store. And it could take us all the way back up again towards the red line here, the 200-day simply moving average at 7,640. So I'm still expecting any minor retracement lower to be bought up and for the upside to be seen, simply because of the technicals that have shown us here that we have broken through some minor downtrends and that the longer term uptrend may actually have resumed. And this can be seen more clearly in US markets, but you can see here on the DAX 40, the German contract, the story is similar in that we've broken through the July to August downtrend line. Now for 3 consecutive days, risen and closed above last week's high at 15,895 on this daily financial bid, both of which is positive. Now, short term, sure, we are being capped by this orange line here, the 55-day simply moving average at 15,962. But that could soon be taken out. And if we were to manage to rise above the 10th of August high at 16,062, then the way would be open for us to head all the way back up again towards the July high at 16,532. So for me, technically speaking, it looks as if further upside is in store, provided, of course, that we stay above the August low and the 200-day simply moving average, which both come in here between 15,469 and 68. So these are the levels to watch for stop losses in case you are long from a technical perspective, at least. Now, the US markets, as I've just mentioned, the S&P 500 fare quite similar in that we have broken through the high scenes last week and closed above these. And here the S&P 500 had 4 consecutive days of gains. And perhaps now today, at the end of the month of August, we could see some minor correction, especially ahead of tomorrow's non-farm payroll data. But the trend reversal that I've seen here, technically speaking, seems to be intact. And again, provided we stay above 4,337, that is to say the current August low, further upside looks to be more likely than any future downside momentum. And that could then take us all the way back up again towards the July high at 4,607 and perhaps even above that. So I remain quite positive on equity indices, not just in Europe, but also in the US from a technical perspective. The US dollar, which over the last 3 days has declined ever so slightly on weaker than expected US employment data. You might remember that we had job openings earlier this week, and those came in at near 2.5-year lows. And then yesterday we had the ADP data, so the private sector employment data, coming in weaker than expected at 177,000. Which also showed that the previously tight labor market in the US is actually cooling down. And we'll have to see whether the same will be the case tomorrow with the non-farm payrolls data. But if that is the case, then that might open the door for the Fed to not hike its rates any longer. But we'll have to see whether that's the case or not tomorrow with non-farm payrolls. We also have to have a look at, obviously, the PCE inflation data out later on today at 1:30 p.m. in the US, because it being the Fed's preferred inflation gauge, it might give us a good indication of whether the Fed will have to hike its rates further in order to push the inflation rate in the US down towards its 2% target. At the moment, it's at 3.2%, but the Fed obviously wants it to go down towards the 2% target. So we'll have to see what the data says. But if you look at euro dollar, which obviously is the inverse of the US dollar, in that when you look at the US dollar basket, the euro makes up 57.6% of that. You can see here that we managed to rise for 3 consecutive days and broke out of this downtrend channel we had been in since July of this year. But on the US dollar strengthening again earlier this morning, the euro has actually come off. And also on those sticky inflation readings out of the Eurozone, as I just said, the Eurozone inflation came in at 5.3% for the month of August, and it did so for the core and also for the headline inflation in the Eurozone. So the euro dollar is falling again and is reintegrating this downward trending channel and may actually perhaps slide to the July low at 108.34. Now, if that support, that low, were to give way, we could be heading back down again towards the red line, the 200-day simple moving average at 108.16. Having said all that, provided we stay above 107.66, the current August low, it is possible that the euro versus US dollar just sideways trades and then perhaps tries to rise back up again over the next coming days and weeks. If you look at the British pound, you can see a similar effect of the strengthening US dollar, in that the the British pound against the US dollar is coming off again today on that stronger US dollar. And it does so after having tried to break through the July to August downtrend line, but not having really managed to close above it yet. So technically speaking, we remain in a downtrend. As you can see here, we have a series of lower highs and lower lows. And that would only change if we were to rise above the 22nd of August high at 128. Only then could we have a reversal in this currency pair take shape. Now, if we were to fall further, and if we were to take out and fall through the August low at 125.49, the next downside target would be the red line here, the 200-day simply moving average at 124.15. So that is a possibility if further weakness were to be seen in this currency pair, probably more on the back of a stronger US dollar than a weak pound. Moving on to the Japanese yen, as we can see here, the US dollar versus the Japanese yen made a new 10-month high at 147.37 on Tuesday. And since then, we've actually come off. But what is interesting here from a technical perspective is that the latest price high we've seen at 147.37 has not been confirmed by the relative strength index, the RSI, at the bottom of this chart. And when this happens, it's called negative divergence. And basically, in about 70% of cases, it does lead to at least a short-term correction against the major trend, in this case, the uptrend, and sometimes also provokes a major reversal. Now, I'm not saying this is happening yet, but it does prep us for a potential sideways trading range below 147.37 over the next few days. And if we were to fall through the 23rd of August low, that's a big if, of course, but if that were to be the case at 144.54 and close below there on a daily chart closing basis, then a top would be formed here, and we could be heading all the way back down again towards the orange line here, the 55-day simply moving average at 143.04. So that is a possibility, given that we've got this negative divergence on this currency pair at the moment. Now, sometimes when you do have negative divergence, in about 30% of cases, it doesn't really matter. The trend continues. So what I'm saying is, if we were to rise instead above 147.37, then the next upside target would be 148, ahead of the psychological 150 area. With regards to the oil price, which has been rising over the last few days on supply concerns, we can see that the Brent crude oil price is continuing to rise, is on track for its third consecutive day of higher prices. And it is trying, as it did yesterday, but didn't quite succeed in doing so, to rise above its 1st of August high at 85.54. And once that has happened, and we've seen a daily close above it, I would expect the oil price to head back up again towards its current August high at $87.83. And a rise above there would put the $90 mark back in vision. So this is basically the view at the moment, simply because we are following the trend higher. It looks as if the August correction has run its course and that further upside is in store for the oil price. From a technical perspective, that is the case. And we have to see whether from a fundamental perspective that will continue to be the case, as the Chinese economy does seem to weaken somewhat. And obviously, with China being the world's largest oil importer, this could have an impact on future demand. But at the moment, the oil price seems to be rising, as we can see here on this daily financial bet. Moving on to the price of silver. What is interesting here is that the silver price has risen by over 11% from its mid-August low in the last 2 weeks, and has touched the $25 mark and is currently consolidating below it. But from a technical perspective, given the fast descent we've seen over the last couple of weeks, provided we stay above the last reaction low, that is to say the low from the 25th of August at $39.92, further upside looks to be more likely than any future downward momentum. And in that case, if we were to take out this week's high, $25.01, we would then naturally head towards the July high, $25.26 as our next upside targets. So that is the case with regards to silver, as I say, provided we stay above $23.92 here. And last but not least, I'd like to talk a little bit about the price of natural gas, because that is heading back up again, once again, basically on the back of worries to do with strikes. And this time around, it's Chevron workers at two of Australia's largest liquefied natural gas or LNG production facilities who want to strike on the 7th of September. And that would put about 10% of global LNG supply at risk. And because of that threat, the price of natural gas has risen very sharply. Yesterday, as you can see here, we have overtaken the high seen on Monday and seem to be on track for the 15th of August, that is to say the mid-August highs at $2.92, and also the June high at $2.93. So these are the next upside targets for the price of natural gas. But we could actually be heading all the way back up again towards the August high at $3.05, and also the red line here, the 200-day simply moving average at $3.07. Now, if the strikes were to be averted, and we obviously hope that that is the case, from a technical perspective, what we would need to see for the bears to be back in control is to fall below the last reaction low, that is to say Tuesday's low at $2.63. And once that has happened, we could then head back down again towards the uptrend line, which has been in place since June of this year. But short term, it looks as if further upside is in store with regards to the price of natural gas. Thank you for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X, that is the former Twitter, and my X handle is at AxelR_IG.